All right. Good evening and good morning, everyone. Those who are joining from India, glad you're joining. I'm Sudheer. I was a SAC 25 investor. I led a due diligence team as well, which incidentally got selected for SAC 25 as a winner. So hey, and here I am trying to do the assistant fund manager for SAC 26, along with Kristann and Jesse. So Kristann, myself here, just going to walk you through some aspects of why we got into angel investment, how we go about it, and what are some of the key takeaways, and how SAC can actually help you, meet your goals in terms of financial goals, or it could be from, more personal goals, what you want to achieve out of angel investment, right? With that, let me share the screen, and Kristann will kick it off.
And while you're bringing that up, I can talk a little bit about, I think sometimes it's helpful to share kind of how we got involved in angel investing and sort of our story. So, my story, like I heard from some of you, I was a startup founder and I was seeking investment, and I wanted to learn how investors thought and what they looked for, and how I could better position myself. And so I joined the Seattle Angel Conference a couple years ago and just really fell in love with the whole idea of working directly with founders and with other really smart people from a lot of different backgrounds to do due diligence. I like to say that the angel investing allows me to move from investing in businesses to investing in people. So, especially in Seattle Angel, I found that we get to know our founders really well, and we get to know their backstories and why they started the company, and we get to work with them and understand sort of how we can shape the future. And then I was also mentioning that I'm an impact investor. And so as I've gone through a couple different rounds of the Seattle Angel Conference, one of the things that we do is really work on developing our investment thesis. And I've been able to really think about, okay, what does that mean? Like what kind of things do I look for in order to be investing in impact? And can I, every company is trying to impact somebody, right? They're trying to sell to somebody, and they've got a value proposition. And how can I help those companies and those founders increase that impact to have more of a social or environmental focus? So that's a little bit about me.
All right. Maybe I can spend a little bit more as well from similar angles, right? I have been in the industry as well for 15 plus years with Microsoft, did like 3 different stints across 3 different groups, and always been in a startup mode of a thing. Although it was Microsoft, started something ground up and built successful 3 different products. And I do have passion for startup and helping companies who are in startup. So along those lines, right? So right now I'm also in a startup company. Recently I joined about a year back as the director of engineering. So one more aspect is in terms of investments, right? Like we do a lot of investments in terms of stocks, properties, mutual funds, and whatnot, right? And over time, you need to also diversify that. Or like, okay, you work in the industry for a while, you get everything set up, and now you need to like, hey, how do I diversify myself? That's one of the aspects that you'll also look at, and how do you continue that high growth that you will potentially have, right? That's also one of the reasons for me to look at angel investment. And third, but last but not the least, is in terms of learning and coaching, right? I have been a career mentor, and I do coach folks to take interviews and from career perspective, right? And I want to like to take my experience, how do I coach startup companies to help them succeed, right? In the meantime, I help learning myself in terms of, it could be people, growth, go to market, or whatever it could be, right? So for me, at least, these were the key aspects for me to start looking at angel investment. right? And more on one more aspect in terms of it will help you establish what is your thesis and what is that you want to focus on in terms of investments, right? So we'll again talk a little bit more as we go into those aspects. All right, after you, Kristann.
Yeah, so this is the topics that we're going to go through today. You heard a little bit about each of us, why we became angel investors. We'll go through kind of the definitions, what it means to be an angel investor, and what the landscape looks like. We talked a little bit about building your portfolio, and we'll also look at how we do some company evaluation and create our due diligence reports. I think we've covered probably enough maybe about why we angel invest. I mean, I don't know that that there's anything more that I can say about investing in people. I think one of the things that we often keep separate are what we're investing in from for our portfolio and to build wealth for ourselves and our families, and from a charitable type thing. And I've found that angel investing can bring both of those together. And John will talk to you a lot about how to do this, but it feels to me like I've got 3 daughters, I've got 6 nieces. I'm helping to make the world a better place because I'm investing in the cure for cancer. I'm investing in solving climate change. Like, I'm investing in these things that are going to really matter, and they really matter to my kids. So, I mean, that's the why I continue to angel invest. And I get to look for investing in people that maybe, might get overlooked. As we all know, or maybe you don't know that, we tend to invest in people that are like us, that think like us, that look like us. And so I also invest because I can look for female founders. I can look for maybe female geek founders like me. I've got a software engineering background. So, I can also help to build up maybe people that are overlooked by your traditional venture capitalist. So let's talk a little bit about what an angel investor is. There's an idea of accreditation that defines whether or not you're in the US, you can become an angel investor. And you're using your own money. You can use money that is in a 401k, or you can use your own money that you've got saved up, but you're using your own money. It's not like you're bringing in money from other places. And then usually we get back a convertible debt or some sort of ownership, so something that says that we're owning some percentage of the company we invest in. But if you go to the next one, how to be a good angel investor. This is really about how to understand what makes a good company to invest in and how to help those companies grow, right? Because an angel investor, we work with the founders. We understand what their business is about. We coach them and we help them sort of build out how what their business model is and their plans. But it doesn't really stop there. So we're also looking at how can we set up the companies that we invest in and help them be successful, help them scale. So a good angel investor is really somebody who takes the time in order to invest in those people in order to build a business that it can scale, and then of course can make a return as well as make that impact. So an accredited investor, you know, if you make more than $200,000 or $300,000 if you file married for the last 2 years, and you have expectations of doing the same going forward, that's one way to get defined as accredited investor. Or if you have your net worth outside of your, you know, the investment you have in your home of greater than $1 million. So that could be a 401k, for example, or if you have a trust that's more than $5 million. So the definition for an accredited investor is defined by the, you know, by the U.S. federal government, and this is the way that you can get accredited. There's no special, you don't have to apply or anything like that. You just have to sign up and say, yes, I've checked and I am an accredited investor. Next slide. So let's talk a little bit about what we invest in, because sometimes I think there's a little bit of confusion. And maybe I can tell a story. I was watching a film recently about an angel investor, and she saw a woman that had built out clothing and undergarments that were specifically for women that had gone through and had a mastectomy. But she just had like a local shop. Well, that is a small business. So that little local shop is a small business. But this investor really liked the idea that we could actually, you know, that company was having an impact and was helping people. And she thought about, okay, how could we get her to do more and to be able to help more people? So she helped the small business owner to build out her business so that it was online, so that she could do a custom, you know, building personalized help for women who are coming through and wanted to get, you know, some of these clothing advice. And now suddenly that business was no longer just a small business, it was a startup that had the potential to scale. So that's the main thing that I think that we look for, and angel investors are typically are investing in startups. So we're looking for a company that has the potential to scale, that has the potential to achieve liquidity. And, you know, it's not a small mom and pop business that just wants to stay, you know, steady as she goes. Next slide. All right, so let's talk a little bit about venture capitalists versus angels. A venture capitalist typically is raising funds from a lot of different people, and they have a large sum of money. So they've created a fund from, you know, different places where they've raised that, and they're making, you know, $10 million checks to companies. And so when you see people that are in, typically it's like Series A, you know, that's where a VC is typically funded, whereas angels is usually between that sort of 500 to 1.5 million. That's the sweet spot for an angel investor. VCs are really looking for that unicorn, those big exits. And, you know, we're, as an angel investor, really more looking at being able to, you know, have a return of 10x or something like that. So we're looking for sort of, I guess, more manageable or more modest returns, but we're looking for that sort of 10x return on our investments. And I talked about the later stage VCs are investing in a smaller amount of companies, and we'll talk a little bit about how big you want your portfolio as an angel investor, but we're usually investing in more and, you know, sort of pre-seed or seed stage companies. You know, I know most of us try to look for product market fit as a, you know, a first indicator that a company might be ready for us to invest in. So let's talk a little bit about the landscape here then. You know, as a whole, the angels will invest about 21 billion in 64,000 startup companies a year. So, we have a fair amount of money to give, and we spread it across a lot of different companies. Besides the Seattle Angel Conference that's looking, here locally, for example, John also has a transatlantic one that's looking, across into Europe. We've also have ones that are looking at specific like industry verticals and that sort of thing. And then in comparison is, venture VCs are investing about 4 times as much, but only, 10% or less of the number of companies. And mostly, of course, they're investing in those later stage companies. All right, next slide. So let's look at this. So as you might expect, that a lot of angel deals are happening in California. And in fact, in the Seattle Angel Conference, we don't restrict ourselves to startups that are located in any specific areas. So I have a couple of California-based companies in my portfolio. But we're investing in about 7% of angel investment dollars goes to Pacific Northwest, or a little bit broader. The next biggest market is in the Southeast, followed by New York State. And it really requires a very healthy ecosystem in order to have a good, stable environment for angel investment to work. And that's one of the things I know I'm passionate about and John's passionate about is how do we create that ecosystem so that we can build out more companies? Because there have been cases where a company, like if in those orange states, who might move to a different state where that ecosystem is better developed. And so, you can see our space is really emerging as a growth area where we can start to actually invest in more companies from our region. Next slide. So this is interesting. We angels typically invest in 1 out of 30 companies we see. I think last time, didn't we see over 100? So it depends, right? But we do look at a large amount of deals and many companies, and in fact, we do encourage companies to apply early with us, because there's a lot of growth and learning that can happen when you apply for investment. I know when I was doing my company, my startup, every single investor that I met with had different advice for me, had different ways that I could sort of refine my pitch and do a better job of sort of evolving my business. So there's a great deal to be learned for any of the startups that come and join the Seattle Angel Conference. And then there's also a great deal for all of the angel investors to learn about the startups and the landscape of the industry and sort of what's out there and what's available. You should expect that a good more than half of the companies that you invest in as an angel investor are not going to return anything. So, even though I said we're not looking for a unicorn, we do, have companies that do carry the load, right? They're the ones who are getting all of the return, while some are not getting any at all. Next slide. So this is probably something that you've seen in the past, but most startups, and if it's an angel investment, this would be considered a failure. Although if it's selling to a larger company or acqui-hire, we certainly get a return for some of those. Probably, one of the thing that we Probably one of the hardest things for us is that Walking Dead category, right? So this is just a company that's hanging on. Maybe it starts to look more like a small business than a startup, but they're not growing, but they're not sort of dying either. And so they just, sometimes those ones are ones that we have to walk away from. But as you can tell, most startups fail because they've gone out of business. They've determined there isn't a product market fit. This isn't the right time for them to be out in this market. They don't have, there's an economic turn. They don't have the customers that they were looking for. They might have a competitor. They don't have the right team. A lot of times it's their team that, isn't the right team of people to actually pull it off. Next slide. Well, so then you might be saying, well, geez, that looks like pretty low odds. I might do better off if I go and go to the casino down the road. But there is money to be made. A 25% annualized return is something that is achievable as long as you're smart about it, as long as you do your due diligence, as long as you've created a portfolio of investments and you're not putting all of your eggs in one basket. Next slide. So let's take a look at return. So Sudheer, help me out with this one a little bit. We see that there is, when you hold on to a company for, so the number of companies, 60% of companies are going to return less than one time. So these are your quote unquote failures, right? Whereas about 20% are going to return 1 to 5 X, and then on up you can see, a very small percentage is going to get to that 30X return. And so as compared to the S&P 500, which is more like 5.3%. And so, you just, as you go into this, you've got to be a little resilient. You've got to be able to hold on to something for 4 to 5 years, and you've got to be ready that 70% of your investments are going to fail. Did I miss anything on that one, Sudheer?
No, I think you pretty much covered it, Kristann. Yeah.
Okay. Okay, next slide. So then this is another way to look at this, but it's really about again holding on. So you can see the if you hold on to an investment for 3 years, probably you're looking at less than 1% or 1X. So that's certainly true for me. All of my angel investments have been in the last 3 years. If I were to say, okay, I'm done now, certainly none of them have given me any return. Some of them I can tell are doing better than others, but they're all alive and kicking and out there working away. But if I, work my way over to the right here, at least one of those companies, if I were to hold on to for 5 years, and I think I would need to add a bit more. I think I'm at like 4 or 5 companies that I've invested in. And Sudheer, I think you've doubled me. So I would need to hold on. I would need to fill out that portfolio a little bit more and then hold on to them for at least 5 years before I can get up to that 30X return.
That's right. I mean, the main thing to take away is the outsized return here, right? So like small number of companies that you invest giving you outsized return, right? And the rest of them are probably either going to fail or you're going to get whatever you're invested back, right? That is the key to take away from this slide at least.
Okay, so why would you want to do this? Well, I hope you can hear from, the way we talk about it is that it's really a lot of fun. And of course, I'm looking at making a difference. As one of the lead investors in the next Seattle Angel Conference, John's told me that I get to gather together the people that I really want to work with, and that includes all of you. So the people that invest in or that work with me on the due diligence say, we become friends and we become colleagues and we help each other out with some of the things. And the diversity of the investors has been fantastic, right? I can't imagine going in and doing a due diligence without having, the person on my team that's got a finance background, the person on my team that's got an operations background, that knows how to do manufacturing, that has done something in China before, all of these different things, right? I mean, I thought I walked into this with a lot of business experience, but I have nothing compared to all of, when you collectively bring all that together. And yeah, we have a lot of fun.
Yeah. To add to that, what Kristann mentioned, right? So, for example, when I joined SAC 25, I had zero knowledge of biotech companies, how to evaluate them, right? What do they mean? What does it mean for patents? When to go to market? What does it CDC mean? Getting approval, FDA approval, and whatnot, right? So, just getting into it, we saw that there's a lot of biotech companies, right? And then it so happened that about 2 or 3 out of 6 finalists were biotech companies, right? And then I ended up doing due diligence for one of the company called Single-Time Microneedles, which is again a biotech company, right? Then we started digging into it and learned a lot about biotech, right? Learned about patents. What does it mean from university perspective? What does it mean from our partnership perspective, and things like that. So, which I don't think I would have ever learned so much about biotech if it wasn't for joining SAC and being part of the due diligence team. And I see David as well here, who was part of work together as part of the due diligence team for last SAC 25, and it was really a fun experience. It's some work as we get to the last few weeks of due diligence, but hey, no work, no gain, right?
Yep. Yep, and we all know what a 510K is, right? All right. So I'm going to hand it over to you, Sudheer.
All right, sounds good. Thanks, Kristann. So, again, Kristann talked about some of the investment thesis that she goes behind, right? Similarly, everybody does, sort of have some sort of, what is the thesis that you want to work with? For me, at least, I have been in, identity and security background for a long time, and making the world a safer and a better place is somewhat I look forward in a lot of ways, right? And some of my investments has been along those lines, where I understand the technology a little bit more, and that's where I invest in. But then again, then as we get into SAC and starting due diligence, you start to learn different technologies. You start to learn different companies that are there out in the system, and how do you evaluate them, and see if those are the right kind of investments that works for you, right? And along the lines, you build your thesis as well, right? So it so happens that I realized that, oh, okay, yeah, now I've focused largely on deep tech companies. Now I can start actually focusing on biotech companies. They're still technology focused. At the same time, it still aligns to my thesis of making the world a safer and a better place, right? For example, I talked about STM, where or CBT, where there's cure for cancer, right? It's by providing this kind of new technologies to be able to make a safer place and a secure place for everyone in the world, right? So let's talk about how do you go about building your portfolio, right? Well, first of all, obviously, you develop your thesis. If you don't have a thesis, great, no problem. Everybody starts with that, right? Not having a thesis. But you start to build, what are some of your interests? What are key things that you think in the world that you need to solve? Where's some of the things that, you need to go, you want to do, but you probably don't have time to do all of it, right? So this is one way of contributing back to the community in terms of being able to invest and see to achieve what you really want to achieve, right? In terms of how do you build it, right? So we'll in few more slides talks about a little bit of math and things like that, right? But at a high level, just like any other portfolio, when you build up, right, you don't put all eggs in one basket. You spread it out. Uh, across different portfolios, right? So in this case, the typical guidance is about not invest in one company or 5 companies, but diversify whatever that you not want to invest in into about 20 companies, right? And we'll talk about why that is the case in a few minutes, right? And again, it's not necessary that you're going to invest not necessary that you invest all of your portfolio or into angel investments. Take portion of it. It could be 5%, it could be 10% of your assets, right? And also look at things like 10% of your cash flow and see if what that means for your investment, right? It could be like, oh yeah, I'll take 10%. It could be take, okay, 3 months to build for a decent amount, or it could be take 6 months. That's fine. Take over 6 months and actually find a company that you need to invest in. Again, there's many opportunity to invest, but what exactly you want to invest is the key, and we need to go behind that. All right. So here's one nice chart, right? So the left talks about the person probability of success, right? And that's the y-axis. And the x-axis talks about what is the return on investments that you will see. Let's take an example here, right? Let's say your goal is to, let's say, get to 2x in 5 years, let's say, right? So if you were to just invest in 5 companies, what does that mean, right? That's the red line here. It's a concave thing. If you see, it's less than maybe about 30-40%, right? But then you go from five companies to 10 companies, right? What does that look like? Now your probability of success is about 50%. Now you go from 10 to 25 companies, then your probability of success is like 60 to 65%. So it only gets better, right, over time. And that's for 2x investments. But now if you look at what happens towards the end of it, right? You'll still never get like 4x investments, even if you invest in 100 companies, right? So that tells you something that, it should be somewhere in the middle, right? It's neither, hey, obviously everybody starts with one, but over time build your portfolio where you'll be able to get into somewhere around, 20 to 30 companies, right? That will give you the best bang for the buck. At least that's the hope, right? Let's take a different view, right? Kristann talked about how like about 50% of the companies fail, right? And some of them return outsized returns, right? Along those lines, say, let's say you invest in 10 companies on the left side that you're talking about, and your IRR goal, run rate that you want to achieve is, say, let's say 25%, right? And then we talked about potentially 50% of the companies actually fail. So let's say in this example, A, B, C, D, E, all of them fail, right? And F and G here return 1x, right? Whatever you invested, you get back, right? One company got you 2 times back, and other companies 3 times back, and you're expecting the last company to be returning 24 times, right, to actually meet your goal, right? Now, then let's take another example, right? Let's say you want to get 25% growth year over year, and your goal is to continue to do it over 9 years. Now, if you really see that the number always gets skewed, and here you're expecting one company to be able to make 68x, right? So it's practically not possible to do this, right? So going back to this discussion, if you will, that's where it's important to invest in about 20 to 30 companies that will limit your risk factor, right? To say that, okay, even if 1 or 2 companies out of your portfolio provides an outsized return, you actually make 25% year over return. That's the key message that take away from here. All right, so we'll talk about building your portfolio, right? Again, going into angel investment, we don't necessarily say, okay, let me go invest 25K, right? A lot of companies, a lot of angel investments you go, the minimum check that you need to write is 25K, right? that is probably not acceptable. Even it was not acceptable for me in a lot of ways, right? So one of the ideas, one of the ways that Seattle Angel Conference actually helps is the fact that the check that you write is 5K, right, for an investment. And at the same time, you're also learning how to do due diligence, how to evaluate a company, how to collaborate and build a team to make that happen, right? So that's where one of the key advantages of getting involved in Seattle Angel Conference will lead you to understand the landscape of angel investments, so you can continue to go invest. And last but not the least, if you look at a lot of um, other angel companies that you can invest in, um, one of the main aspect is that there's one person or two people who are actually doing due diligence, right? And you're relying on the fact that they have done a good job, right, doing the due diligence. But if you look at things like SAC, where you have about 30 to 40 investors who are as part of the cohort or working together, right, to understand what is the best company to go invest as a group, right? So it's just not like one or two minds working together. It's about 30 to 40 minds working together to funnel down to set of companies that you really want to invest in, where as a collective mind, you'll say, hey, yes, this is the right thing to invest. So that way you actually have a higher probability of success, right? Rather than one person doing the due diligence and someone actually investing it, right? I think that's one of the key factor in my opinion, from being part of SAC like conference. So again, we talked about invest in what you know, right? Going back to industry experience, right? You tend to navigate yourself to the areas that you're familiar with. It could be biotech, it could be sustainability, it could be security, it could be anything else, right? Biotech. So that's where you'll probably start, right? He's like, hey, I don't know anything about a specific company, right? I'm skeptical of investing. But then being part of the group will help you learn, understand how to evaluate different companies, different technologies, different sectors, right? And be able to learn and navigate towards building your thesis to be able to be investable in those companies as well, in those sectors, if you will. And we talked about here, this one as well, right? Say, for example, someone like a venture capitalist, right? Or some other angel company, passive angel companies that are doing is probably like one or two people doing the due diligence, right? Which means that there's a limited time that everybody that who is doing their due diligence is spending. But here, when we come to SAC and doing, and we spend over collectively, if there are two or three people working on one company to do the due diligence, you're spending over like 60 hours, 80 hours over a period of time on one company to actually on doing the due diligence, right? So that way, you're better positioned for success in a lot of ways. We talked about a little bit of different types of angel investments, right? It could be lone wolf, right, where you're going and investing on your own. Again, it's one mind, trying to do the due diligence, right? Or we have active angel investment group, like Seattle Angel Conference is one of them. We have Venturous is one of the recent angel companies as well. And then we have passive angel funds, right, where it's again a thing like where you're on your own to do the due diligence. But if two or three angel investors come together, the passive angel funds also invest partly into those companies, right? And then we have other companies like angel networks, right, where you're just going and investing, and they have usually a typical check of like 25K. There's also online platforms and syndicates, right? In fact, I have went and invested few in AngelList as well. But again, you're shooting in the dark because they'll give you information about, okay, here's a company that we are looking for investment, but here's a limited set of details, right? But then you're limited in terms of what you can actually do with it, right? You can do your own research, right? But you're restricted from going and talking to the founder, going and talking to other advisors or anything like that, right? So that's where one of the key differentiator as well when it comes to SAC, right? As a matter of fact, David and I went and talked to pretty much everything that were involved as part of single-time microneedles in the past, right? And in the past SAC 25 conference. That was quite invigorating experience, in my opinion, and learning about various different aspects and what are the things to look at and what are the red flags that you can catch, right? That help you lean towards an investable company or not. Let's talk a little bit more about evaluating companies. Let's say, hey, okay, and now we want to go build your portfolio. How do you evaluate a company, right? Needless to say, a lot of companies do fail, like what Kristann talked about. Now, why do startups fail, right? There's no market need, right? Or there could be running out of cash, or not the right team, or not or got out competed, right? So there are various different ways that a startup fail, right? And that's also a factor where now with when you're trying to do due diligence with a diverse cohort set of folks, you're bringing in different mindset and different expertise onto the table to understand from different perspectives. Say someone could be into finance, someone could be into marketing, someone could be into biotech, right? So you're bringing in different perspective, and you can lean on each other, right? Although it's a big cohort, and we lean on each other to understand, is this the right thing to do, or do you see red flags to it, right? Being able to understand and comprehend these is one of the key factors when it comes to SAC. And similarly, why do companies succeed, right? Market timing, could be team, idea, business model, and funding, right? It's an exact opposite of why do companies fail and why do companies succeed. And again, going back to the fact that you are able to evaluate different aspects of these as part of the cohort, right? And make a conscious decision. What makes a great company, right? This will also help you go build your thesis and build your due diligence better, right? Well, what are the real problem really to solve? And is it really a problem, right? For whom? And then you talk about, and if it's a really problem, okay, how much big are we talking about, right? And then you talk about the team, right? What is their expertise, right? What background do they have? Are they set up to set up to take the company forward, right? Do they have experience in doing something similar, and are they resilient enough to not give up and keep pushing when things are hard, right? And more importantly, it's one of those things where it's undervalued skill, but are they able to take feedback, right? So that's a very important skill as well. That and being on the ground, doing due diligence will actually help you evaluate to see if this is the right fit, right? All right. So that brings us to summary, right? Um, Now, we talked about 25% IRR, right? Rate of return for over a year. So what that means, right? If you do due diligence to the due diligence, right, and invest in diversified 20 companies, then you have a better chance of 2.5x in 4 years if you do 25% year over return. Right. Again, it's going to take time to build a portfolio, right? Just like any other thing, it takes time, right? So being at it, spending time, and understanding what is that you want to focus on from your thesis perspective, from evaluation perspective, and take step by step to get to that place. And we talked about outsized returns. A small percentage of investments make the most of the portfolio. And last but not the least, right? The Pacific Northwest and this Seattle area is a pretty happening state, right, and city. And we have seen a lot of companies coming up, and SAC itself is not restricted to taking investments from Seattle only, nor taking evaluating companies across the world, right, across US at least. Obviously, everything comes with a asterisk, right? So you don't want to invest. We talked about, we looked at the graph, right? You don't want to invest in 5 companies and say, yes, that's good, right? Because the probability of success is going to be low, right? And then this is again data that's shown over a period of time, and it's not specific to SAC or anything like that. And it could be outdated too. All right. And these are some of the resources that, you can go reference, go look at it, and actually apply it if you were to join SAC for SAC 26. All right, that ends the presentation.
Thanks, Sudheer. Yeah, we'd love to hear, what questions you might have, what you're thinking about, where you are on your angel journey. What's top of mind for everybody? I guess I could ask Sudheer a quick question. What's been your favorite investment? What's your favorite company? I posted my favorite company. What's the favorite company you invested in?
Yeah, I've been again a recent investor, I would say, right? So I've been investing just over 2 years now and slowly getting my feet into it. I would say not that time because I'm part of SAC and representing SAC, but actually I had the most fun investing in the SAC 25 company, which was STM, right?
Yeah.
And also as a sidecar, we're also trying to invest in the CBT, which is also a great company. It's for me, it's more about the process, right? And seeing if it actually fits into your thesis, right? And felt like as like you're going to invest companies, it's like, yes, you go do a due diligence report and saying, okay, fine, great, I'll invest into it. But then actually doing a lot of legwork on your own, right? That also helps you understand, okay, great. Is it something investable? Is it something that I can put my money into?
Right. Yeah, and Sudheer mentioned sidecar. So we in Seattle Angel Conference, we pool our money and we give a single check to the winner of the conference. We sort of slowly winnowed that down. But a lot of times as we go through that and we go through the due diligence, we uncover more than one company that is investable and that we'd like to invest in. And so we create what's called a sidecar. And then, so it's cool because you get, more bang for your buck, basically. We've all gathered together and done all of this due diligence, and now we have more than one company that we can invest in. Matt has a question. What tools do you use to manage your due diligence process? Oh, you want to take that, Sudheer?
Sure. So like reference, right? There are a few reference books that you can start with, right? To understand what are the how do you even get started? What are the questions to have? What is the checklist, right? There you go. Kristann has her angel investment.
Great checklist at the end. Yeah.
It's a great checklist at the end. Honestly, the checklist was useful, right? But not at the expense of the great cohort that we had, right? Because you meet on a weekly basis and you put your thoughts to it, right? And you get back like 10 different thoughts to it, right? And then you have other groups, other companies actually come and presenting similar fashion is like, hey, we did that research. We did, we looked into that. So, and these are the questions that we asked, right? And then as a cohort, you're actually forming these questions and what to ask and what to look for as collectively, right? That I think is more fun, right? And then and then we had few reference points to for on the due diligence reports as well that were shared, right? Again, you take it as a reference point and you tweak it and make it your own, right? So.
And David Rose he's the founder of Gust, and Gust is where is the tool that we all use to sort of, that's where all of the companies, the startups apply, and then we also use it to sort of give our feedback to each other and rate companies on different things. So that's probably the main one tool that we use, and then everybody is, I mean, a key part of the Seattle Angel Conference, I think, is building out what tools you want to have. Some people are more analytical than others. Some people use, different methodologies for doing that analysis that may not, lend itself to a spreadsheet. So, we've all got our different mechanisms. Yeah. John posted Gust. Let's see. Stephen, when you are completing due diligence, how do you measure gauge traction? What do you think, Sudheer? Want me to do that one, or you got it?
Go for it.
Okay. I really want to look at, I typically want to see how the company defines traction, right? So you'd be amazed at how many companies don't even know what their business model is, right? How do you make money? What are your expenses? What's your margin, right? I mean, it's like as basic as that. But I want to know from a traction perspective, have you made any money, or do you have any indicators that that's something that's coming up? Have you been able to validate whether or not that expense projection that you've created is true, so that return, that gross margin that you're talking about is actually going to pay out, is going to come to fruition.
Yeah. And one more thing to add to that as well, right? So to start off, let's say there are 100 companies that are applying for SAC 26. You're not doing due diligence to all 100 companies. It's almost impossible to do it, right? So so we go through, John and Kristann can also add to it, and others who have been in the system, right? Where you go through a triage process, if you will, right? To see in terms of at a high level, they go through multiple rounds, like 1-minute pitches, 3-minute pitches, 5-minute pitches, 10-minute pitches, right? So you go through the filtering process, right? From 100 companies, you're probably eliminating like 20-30% of it. Then and then you go to the next round, you again eliminate like 20-30% of it, and you'd get, after like 4 or 5 rounds of elimination, you're probably left with about 10 companies, right? And then you do like a little bit more thorough investigation, and then you're finally left with about 5 to 6 companies where you're doing the due diligence. And the due diligence process is about 4 weeks, right? That's where you split into groups, and each group is actually taking one company and going deep into it, right? In terms of, it could be finance, it could be marketing, sales, team, go-to-market, technology, patents, everything around it, right? And then you finally generate the report, and then you select one company out of it, right? That's typically how it works.
Right. And Vinyaka asks, from a startup perspective, what value the Seattle Angel Conference investors bring to the table. So one thing that I guess from my perspective, everybody who's gone through, every founder that's gone through the Seattle Angel Conference has told us that they have just learned a ton in it, and going through the process has helped them sort of build out their their pitch. So, everything from starting with, we coach you on how to give that pitch, and we give you feedback, and we ask you questions. And yeah, some of us are brand new, and we're, still learning what questions to ask, but it's really important that you hear that. And then the other thing I guess I would say is that, The people that are investors in, and this is what I really enjoy about being part of Seattle Angel, they're no slackers, right? I mean, these people are business people that have been in a ton of different industries, so their questions are good. And having been through several, like I said, VC conversations, I actually think they're better than VCs that have been very sort of single, narrow-minded, right? You're going to get just every different questions from every different perspective and different roles and people, with different backgrounds.
Yeah. Yeah. Add to that, I think many of the actually the final cohort of companies that they came, everybody actually talked about how thorough the due diligence was, right? A lot of us were actually first time doing due diligence, but because you are putting your money and soul and heart to it, right? So you want to make the best out of it, right? In some ways. So it so happened that the due diligence report that were generated were actually better than any other companies that actually do the due diligence, just because you're running as a cohort, right? You are bringing different mindset and different diverse perspective to it, right? And each one of us are taking different parts of the system and trying to evaluate independently and coming together as a one cohesive report, right, that everybody can reference. So and some of them like came out and said, hey, it was so thorough that even some of the seed investors and Series A investors not and have not done, and they took the report and actually shared it with the other investors for them, make it easy for others to do the due diligence.
And the other thing I want to mention is that we have a final demo day at the end where we bring all of the finalists. So we have 6 finalists who will come and do a pitch at the end of the cycle. And this is where John's network and all of our investor networks really come into play, because we invite all of those other investors to come to that demo day. So the exposure that you have to real vetted investors in that demo day is pretty big. And many of the companies, even if they haven't won the check from Seattle Angel, will attract and make connections with other investors.
I'd love to hear a question from Lisa, who's dipping her toe in.
Yeah.
I think that this has been really informative, and I so appreciate the perspective, and some of the things that I'm hearing are resonating for me. And I think, what I'd like to understand is I actually did see what was going on with this organization right as you were finishing that last round in the spring. And so I was like, well, I'm going to kind of try to get ahead of this and see if I can't, figure out how to be part of the conference come this fall. So hence why I'm here. So I guess my questions are really about, what does it really look like to be a part of the conference? Like, what should be the expectation of me as a participant in this process? You talk a lot about, the due diligence and the meet together, but I don't really have a sense of what that really means, boots on the ground, if you will.
Well, we meet every Tuesday evening for 2.5 hours, so from 6 to 8 p.m. So from a time frame, you've got to be ready to make that initial investment. It means doing your own research. So if we've got 20 investors and 100 companies to look at, we'll divide up those 100 companies and guests, and everybody's got to go out and touch, at least, 10 to 20 of those companies and do that initial research and give some feedback and share their thoughts on with everybody else. So, we do that. And then, that's the point when I create my spreadsheet, and I try to at least touch every single one of them and understand where they are. I won't do as much of research in that first one. So that, usually will take me, a couple of, 2 to 3 hours on the weekend to kind of do that, to prepare for that Tuesday meeting. And that sort of continues on with that like 2 to 3 hours on the weekend. It feels like I don't know what you found, Sudheer, but like if I do that homework a bit on, Sunday, or sometimes when I'm late on Monday night, then I feel like I can come to the meetings on Tuesday. When we get into doing the due diligence, we do, we'll sometimes meet outside of that Tuesday evening. So we've got a due diligence team of 5 or 6 people, and we'll often, get together maybe right before at 5 o'clock on Tuesdays, or find another time and spend a bit of time talking about where we are. We do interview all of the founders. So we will set up separate one-on-ones with the founders, with their advisors. We always ask to talk to a customer or a partner so that we can get sort of that. So as you get to the crunch time, there's a few more meetings, I think, that usually happen towards the end. I don't feel like I spend a huge amount of time writing the due diligence report, because, we're sort of writing it as we go. And so it's not like I'm, staying up all night like a college student and writing a paper. We're sort of writing it as we go, because every week when we come and we get together as the conference, or the cohort comes back together, we all report out. So I think Sudheer touched on this. If I'm doing the due diligence, if I'm the due diligence lead for single time micro needles, I'm going to come and I'm going to say, this is what we found out so far, and this is what we like, what we don't like, a risk that we've seen. Do we still think they're investable? And so there's a bit of that's happening that really helps us build out that due diligence report, because we're also getting questions from other people, and we're hearing how everybody else is doing their due diligence. And that's what I want to do something a little bit more of that. I want to ask that question. That person really looked at something, and so that's where I feel like I can do such a better job. I mean, maybe it's just me. I get a lot of energy working with other people, so I really get a lot from all of those interactions. And Sudheer, I said way too much. I'm going to turn it to you.
No, you hit all the right points, Kristann. It's really like if you're being able to spend few hours a week, right, that will help you set up for success for sure, right? Being able to again here, the reason that you're here, yes, investment is one aspect. Other aspect is being able to learn, right, of different companies that are there. How do you evaluate companies? And you can't find a better way than being hands-on and learning, right? That is the key point, right? It's again up to you how much you want to spend, right? But bare minimum, if you're able to spend few hours, 4 to 5 hours, I would say 2 hours, you're actually on the call Tuesdays, and some weeks it's 2 days, Tuesdays and Wednesdays. And if you're doing again so and so homework, right, on the weekend for a couple of hours, I think it'd be pretty good, right, to be able to get to a place where what to look for, how to evaluate, how do you weed out companies, right? It could be from team perspective, or market segment perspective, or it could be aligning your thesis, right? So that way you will actually learn. It's sometimes it's mind blowing. Like, why didn't this company select out, right? But over time you'll start to understand that oh, okay, maybe because they don't have a strong team, or maybe because it's not a good market fit, or and here again we are all humans, right? We are all humans coming and working together to see if something is a right investment, right? As a common man, just like you and me. So always our thinking goes along the same lines, in somewhat similar lines, to see if that's a right investable company for you and for among the cohort, right?
We do have some healthy debates, don't we, Sudheer?
And I think John has such a deep connection built out across Seattle and outside, right? really any help you need, I'll be able to like go again, get you connected with appropriate folks to be able to go deep into some of those as well.
John, I'm wondering if this might be a good question for you. What does Seattle Angel do after the event and the investment is done? How much do we stay involved with the company?
But really, the engagement with the company varies a great deal. It depends a lot on the SPV organizer. It also depends a lot on the company. We've had everything from, the company goes quiet and we have to go grab them by the shirt collars every time we remember to get a report, which we have just done to one of the companies, in fact. And then to all the way to one of the investors being so enthused that they took $100,000, quit their job at Microsoft, and joined as part of the founding team. So really wide range of behaviors between people. Somewhere in the middle, we expect to see weekly or quarterly reports about how they're doing. We expect to get questions early on for, can you introduce me to this person, or do you know how we can address this problem, kinds of things. Usually we're pre-seed, which means that there's another seed and maybe another 2 seed rounds before they go to Series A. And so introductions to the next level is something that we work on. Specifically at the final demo day, we invite a bunch of the follow-on angel groups to come, and often all of our finalists are invited into one group or another to pitch and go on and work on things. Whether that turns into an investment in this round or the next round is depends on the company a lot. We did, in this last round, carry one of the companies into the Keiretsu syndication program, and so we're trying to do more of that. There's about 70 groups in the Keiretsu syndication group that get together every month and say, hey, I have this deal that we're working on. And so it sort of spreads the note. The one that we took in this last time got 6 leads of people that were interested in hearing more, and perhaps were willing to continue investing in that round. But eventually the Series A folks should be taking over those roles, and we'll just have a little line on our Carta table, and we'll be getting our semi-annual reports back. And then at some point, there's an exit of one kind or another. We have one company that went public. That's its own little strange little journey. We have a couple of companies that have exited for small amounts, but we have no real mergers for big amounts yet.
And you said something that I want to make sure, SPV stands for special purpose vehicle. So that's a big part of my job and Sudheer's job is to create a vehicle whereby we can all insert our checks. So we're basically creating an investment vehicle for our money to go in. So if you weren't familiar with that term, that's what the SPV means, special purpose vehicle.
And then Vin asked the question, we don't do follow-up. And what I think you mean is follow on. And so if I were a venture capitalist, I might take 60% of my fund and set it aside for follow on. The fundamental single principle that early pre-seed investors need to hold their hands on is that we don't know anything, right? The uncertainty that's involved in the startup is way, way bigger than any of the data that we can collect. We can get sort of a little dotted line picture of what this company is, but what it really is, we have no idea. So the opportunity for us to know anything about what's going on besides a gut feeling is relatively low. And it's not really until you get to Series A and maybe past Series A that any of the valuation equations that the MBAs get taught actually turn into real numbers, right? we take all of the data from what the seed people give us on their spreadsheet. We look at them, we throw all kinds of error bars on them. And in the end, we sort of get a single digit of approximation that might be off by a factor of, I don't know, 4 or 5 without too much trouble. You should be much closer by the time you get to Series A. And Series A is where you should think about this follow-on. And so if you really are intentional about follow-on metrics, that is picking winners, which I would say in pre-seed and seeds, the data from our Wilt Bank data and the Angel Conference data since 2002 is we can pick losers and get rid of the ones that have significant flaws, but we can't pick winners. The performance of the finalists are not statistically different from the performance of the winner. And so we basically can't pick winners. This is the lesson I take from that. And so if you think you can pick a winner, you better wait until you have some data. And the only point where the data makes any sense is somewhere after Series A. So then you join Series A fund if you want to do follow-on. Other thoughts? So we have several people here who were previously investors. Akash, did you learn anything in the Angel Conference?
Yeah. Can you hear me?
Yep, you're good.
Yeah, I think this was my first tryst with investing. I think it was SAC 24. I was interested, but didn't have the technicalities and the know-how of how to do that. It was pretty involved with respect to time. But the act of going through the due diligence was very fulfilling. You get to learn a lot through the act of due diligence, and a whole world opens up in terms of where does angel investing fit in, what are the other kinds of investments, what do you get for it, as someone was discussing the slides earlier. You take a lot of risk, you invest, you reduce the risk, but what do you get for that? What are the instruments called? You get to know about SAFE, you get to know about convertible debt. So once you have that vocabulary, I think a whole new world opens up, and it makes a lot more sense going forward. At least that was my personal experience, and I'm glad I joined SAC 24.
Well, glad to have you there. Any other thoughts about previous SAC experience from the alumni? No, David, thoughts? All right, we lost
David
Mark.
had the best questions, though. David always had the best questions.
He had
right?
really good questions.
Yeah.
So Matt has been very vocal on the Seattle Startup Friends Discord group. Matt, you got any questions you want to ask?
Oh, sorry, my connection's really bad, so I've been off the mic and stuff. But yeah, I asked about the tool. What tool do you use for due diligence? And I guess you guys are using Gus to share notes and things. That was kind of my main. That sounds cool.
Sadly, the real answer is Slack, spreadsheets, Google Forms, email lists, with weird meetings in between that have little handscript notes in various places. It's not nearly as nice as you would like. Yeah, David.
Yeah, thanks. It was just touched on that there is a significant time investment that is involved. SAC 25 was my first attempt at this, and it took probably twice as much time as I thought it was going to. The SAC meetings take a lot of time themselves, when you land on a diligence team, which you're sort of obligated to do, that's at least an additional hour or two per week you should allocate, and then at least another 2 to 4 hours for evaluating the materials that you collect during those diligence meetings. I think it was a mistake on my side for not allocating enough time for that. Then the other thing I think also is I was very, very surprised. The SAC group does use Gust. I thought everything would be in Gust. Gust does not deliver, I don't feel like, visibility to data that we want to look at. And 100% of the participants from SAC 25, I feel like, all had their own spreadsheets or mechanisms for analyzing the data that they were getting from the various companies to see this. And I asked a couple of the other participants to look at copies of their spreadsheets. Is Trista on this call? I remember looking at hers. And is Martha on this call? I remember looking at hers a lot. Those were very, very good ones. And they had lots of metrics they were measuring. And Martha particularly had a adjustment scoring rubric across a bunch of different facets of the business. It was surprising, and definitely some measurement systems that did not exist or didn't seem even possible from the interface that Gust provided. You got to like put your own magic calculator together.
Yeah, I think that's fair. But the sharing of those spreadsheets was enlightening for many people. So it's a useful teaching tool regardless. Stephen, you have any questions? No? How about you, Dory?
Yeah, you know, I'm new to this, and I guess my question is, you know, what wows you? Is it mainly the people, the way they present the information itself, techniques? Just curious, what catches your interest early on?
Well, let's start with Kristann on that.
Yeah. I mean, like I said, I like their stories, right? Everybody is, you know, it's hard being a startup founder. And so everybody's got these fantastic stories about how they came to be a startup founder and what their journey like, and how did they discover the problem that they were solving, and who did they talk to who has the same problem, and how did they connect to those people that you know really needed their solution. And just in, you know, in involving their families and their friends and all that kind of stuff. Like it just really, that's my favorite part. And it would, the really good ones, it would be in how they presented to us the first time, because we start with a 1 minute pitch, but it would also be in the materials that they uploaded on Gust about, you know, who they were starting this company with and who they plan to serve.
Sudheer, how about you?
Yeah, adding to that, right? So a lot of people have a lot of different ideas, right? But not everybody can execute on it, right? Mm. And being investable is just not about idea, but being able to understand, is there anything meaty in it that you can actually go get out of it, right? Is it like, hey, I have an idea. Okay, I'm using this as a forum to get money to actually go see if that's a business, or is an idea, I have done this groundwork, I have proven that, yes, it sort of works, right? And I've gone to try to sell this, and I know these are the bottlenecks, and I need investment for this, right? So be someone who is able to articulate that well, right? And who has already done the homework and is ready to give fullest to it, right? For me, at least, that's what resonates, right? To say whether you want to invest in a company or not.
So for
Thanks
me,
for that.
my approach is to focus on creating new angels. So I'm not really paying a lot of attention to the companies, other than to try to convince them that customer development and lean startup methodology, where you actually do traction before you do product, makes sense. But beyond that, I'm not tracking anything. And the reason that I'm doing that is because I have a mission from God that is economic development. And in the economics of making startup ecosystems go better, founders without feedback are crappy founders. They do not resonate. You know, there's the story of the Biosphere 2, where they put, you know, all of these people into this dome and they planted a bunch of trees. And the problem with the Biosphere, besides the fact that they didn't calculate that bacteria actually use oxygen, is that the trees had no wind. And because the trees had no wind, they were not strong and they fell over and hit people. And so startups that have no friction from angel investors are weak startups often. They're sloppy startups because there's no meaningful, deep feedback mechanism. So when we do angel investing well, and we do our due diligence well, and we do our filtering and feedback well, the whole ecosystem gets stronger. And so that's why I'm working on this, right? And so if you as an angel are not trying to make the ecosystem stronger, you're missing your main role. Any other thoughts?
That's cool, because this week, I don't know if anybody's participated in this, the Pacific Northwest Climate Week, and everybody I'm reading or that I'm meeting is working on creating an ecosystem of problem solvers for climate change. And so the power of building that really strong ecosystem can't be understated.
Yeah. And this is the thing that will solve cancer. And this is the thing that will train our kids for the future. And this is the thing that will get fusion to finally work, and all of those things. In fact, just to say, we helped a company in Corvallis when I was doing stuff there get out of the university called NewScale. It makes small fusion or fission nuclear plants. And they're now on the public market, and they're now starting to address this question of carbon dioxide in the air by being able to deploy their thing finally. So that was 2007. We started with them, and now here that is 2024, they're finally making progress, right? So this is a long-term journey. It's illiquid along the way. You'll learn a lot about a lot of people and a lot of things, and you'll discover that you get to see a little bit of the future long before everybody else gets to see that future. So I'm not hearing a great rush of questions. So thank you, Kristann. I really appreciate the hard work in being the SPV organizer. Thank you, Sudheer, for being the assistant this time. And double thank you for being part of the SAC 27 process, since you get to do this again next time. So love to have any questions. We'll do more workshops here. The next one being next Thursday with the pitch deconstruction. And if you look at the meetup group for Seattle Angel, you'll see a bunch of this stuff. We'll try and put these recordings on the YouTube channel. And all of that is in the chat, which if you click the little 3 dots, you can save the chat and get all the links and comments that we posted in there. And there are some good articles that were posted.
And we should mention that everybody should sign up early, because we're planning a bunch of learning meetups in July, in August specifically for the next cohort to really sort of dive into and learn, you know, before we get started.
Yep, absolutely. Thank you.
Thank you.
Thank you.